Good afternoon, all. Thank you all for joining us today. In today's webinar, we have an esteemed guest, Mr. Swarup Mohanty, the Chief Executive Officer and Associate Director of Mirae Asset Investment Managers, India. He has over 27 years of experience in the field of financial services, including 20 years plus experience in asset management sales. He is overall responsible for the India AMC. He has been associated with this AMC as head sales from July 2011. Prior to this assignment, Swarup was National Sales Head Retail with Religare Asset Management in India. He has also been associated with organizations like Aditya Birla Sun Life AMC, Franklin Templeton Asset Management India, and Kotak Mahindra Asset Management in sales responsibilities. Apart from his passion for mutual funds, Swarup shares a keen interest in travel and music. He has a large collection of vinyl records and prefers the analog form of music. His deep interest in wildlife takes him from one wildlife sanctuary to the other. As you all may know, Scripbox is India's trusted digital wealth manager. At Scripbox, we believe that good investing is not just about choosing a fund. It's about understanding your aspirations and goals, building a portfolio, and managing it actively so that you do not compromise on your dreams. We are a SEBI-registered investment advisor. We keep sharing insights, ideas, and content on a regular basis on topics related to investments, aspirations, life goals, leadership, and health. Please visit our website, scripbox.com, social media platforms, and subscribe to our channel, Scripbox, on YouTube. If you like this webinar, do tweet about it mentioning the handle Scripbox. Welcome, Swarup, to this webinar. Hope everyone in your friends and family is safe.
Thank you so much, Anup. And on behalf of Mirae Asset, I'd like to thank Scripbox for giving us this opportunity to come and discuss and share our views at such a very interesting time in our lives. And I'm doing okay. I hope everybody is fine at your end and your team. All good, I hope.
Yes, Swarup, thank you very much. Everyone is doing fine, and we hope so that we'll all remain safe.
Correct.
So, Swarup, today's webinar topic is, have the fundamental rules of investing changed since last year? We have seen an unprecedented increase in the investment activity. According to SEBI data, new demat account additions rose to an all-time high of 10.7 million between April 2020 and January 2021. And the same number was half of what it was this year. It was like 4.9 million this year, or last year, sorry. So no one had foreseen the stellar gains in the market, including mid-caps during the last year. And a lot of it is ascribed to the active participation of the millennials, young working people, and women. So do you see a systemic shift in the investment pattern in India?
This was, according to me, a very natural progression for the country. Let's face it, that we are today amongst the youngest countries in the world, average age of late 20s or just below 30. That makes the behavior pattern itself very different from what it was, say, 10, 15 years ago, where the average age was slightly higher. Add to the fact that you are shut down in your houses, and the only way we talk, this is the first time I'm talking to you in this medium. All other discussions with you in the past were physical in nature. So we've been restricted to this digital world, and then prior to COVID, let's face it, prior to COVID, there was a fair amount of digitization happening. And then when the country gets younger, it's just a matter of time that everything then shifts to the phone, not the laptop, and everybody owns a smartphone. There is this saying, pre-geo, post-geo, and post-geo, the connectivity is at a different level and at a different cost. This was the background, and it was, I would say, just tailor-made for COVID to come and take digitization to a different level in the country. And that's what has happened. And when you look at the number of demat accounts that have opened, and make no mistake, I'm sure when today people come and transact with you on Scripbox, it's just a matter of minutes on the phone. And opening a demat account, which used to be a cumbersome sort of process earlier, which then was dissuading mutual fund investors from opening demat accounts and transacting mutual funds in the physical format, is no longer what it is today, right? the ease of transaction, we sitting at home, just stuck to our computers and our phones, and the age getting younger, the digitization is a natural progression. I mean, for me, everything changed when I saw my wife buying vegetables online. That's it's a unthinkable thing, but it's very natural that the person comes and delivers vegetables today at home, which is bought digitally. So the journey from vegetables to consumer durables to financial services or owning financial investments in the digital fund is just a natural progression. So though there has been a phenomenal change, I don't think the change was any sort of not apprehended, or maybe it's happened quicker due to COVID. But yes, it was anticipated, and COVID just sort of enhanced the process, is my opinion.
No, actually, very well said, Swarup, because I think what would have taken maybe 5 years, 10 years for companies to change or people to adopt happened in a matter of like months during last year. It was probably, we say, necessity is the mother of invention. So probably because of that. And that's why I think our platform like Scripbox kind of really comes in there, because people have that ease of transaction and they can quickly open their accounts and get ready to transact immediately. So yes, that's true. And the infrastructure has just been accelerated because of that, right? So
see, I thought I was digitally savvy or technologically savvy. When COVID happened and what unfolded reduced me to a nothing. I felt I knew nothing, and the amount of upgradation all of us have had to make. Right. I'm sure you are anyway a digital platform. We were a lot of physical at our end, but let's face it. During when the COVID thing happened, the regulator per se came and said that everything physical had to stop.
Correct.
That's something which I never thought would happen. Officially, we were not accepting physical forms. That's a reality.
Now you can do video KYC, right? So
you can do. So that's what I'm saying. Look at the ease of KYC. Look at the ease of opening a Demat account. It's just 5-10 minutes, and you're through. Go on are those paperwork. This you have to attach. There you have to attest. It's just seamless now. So then, with this kind of ease and the population getting younger, their awareness or their affinity towards this, I do not know where this has come genetically. I'm definitely somewhere kahin to rahega. Suddenly they are more savvy with the phones and these than we were. It's a fact. And when it is their turn of behaving in a certain way, it will only be in the digital form.
Correct. So do you think investment patterns are different in India as compared to other countries, the developed countries like the US, the UK?
I think the key word you said was developed countries. So every country has its own phase, and every country has their own economic sort of status to be in. And let's put that in perspective. When you look at the penetration of mutual funds per se in say US, it's 120% AUM versus 2 GDP is their ratio. In UK, it's in north of 60%, almost 65-67% of the AUM or the asset under management of the mutual fund industry, that's versus their GDP. So that is the amount of penetration they have versus say India, which is at 12%. Right. The point I'm making is the ownership of investments in the financial form or owning financial assets there is far higher than that of India. Because this is a natural progression. If you look at India, the most favored asset classes still are physical in nature. It is mostly real estate and gold also in a physical format, which has been the journey till now. But look at where we are as a country. We are at a very, very interesting threshold. Systematically, let me give you the thresholds. Okay. The country is younger, which I said is number one. Number two, the economic status of this younger country is far better than what it was, say, 2 generations ago. Inheritance is real now, almost. And families have also changed. Earlier there used to be like my father's family is 1 father, 5 sons. Now it is 2 parents, 1 kid, or maximum 2 kids. So when you look at the same kitty, which will come to the next generation, is far bigger than what it was just 2 generations ago. So the situation that is happening in the country is very different. And at 12%, it's a very interesting sort of correlation. When the AUM to GDP sort of crosses this 10% threshold, the real penetration in every country has happened. But when you look at, say, the US and the UK, you also have add to the fact that, the interest rates are pretty low. In spite of mortgages being low, the inclination to real estate is not as high as that is in India. And finally, India real estate prices are reaching a position where people are now looking at rental income. I think you sitting in Bangalore is a great example how the young today are opting for co-living rather than owning a house.
Correct, correct.
The patterns are changing because clearly the younger generation has far more surplus because of there is being a serious inheritance now coming in than say my generation had. Definitely I had more than my father said. So when you look at that economic strata compared to us in UK or US, which is probably 8-9 generations of creating wealth, versus us probably the third or fourth generation creating wealth, it is fundamentally wrong to compare. We are still not there. They have evolved as investors into the financial space. We are just beginning. But our data says that the change can happen very abruptly. And that is what is happening at this moment. I do believe that there might be no correlation, and I'm repeating, there might be no correlation in the way people will own or invest going forward to that of the past. Because everything stands changed at this moment. And that's why India is at such a fantastic threshold in all aspects, not just investing. And another more psychological thing I think that's happened, and I do believe, like there was before Christ, after Christ, there will be before COVID, after COVID. This BC will change, right?
Mm-hmm.
And then when you look at all our lives in this 1 year of sitting at home and facing death around the corner, mentally, I think we've been able to segregate between needs and wants. And when we come out of this, I feel our concentration will be far higher than on the need side than it was on the want side. Bringing the importance of financial investing or the importance of financial well-being far higher on the other side of COVID than it was before that. So we are at that threshold, is my opinion.
What you're saying is we're just getting started. And actually, one thing I wanted to just mention here is that sometimes what happens is India's had an advantage where we have taken leaps, right? We have skipped some things, right? So the whole telecom thing, we never had any landlines, right? We just skipped that and just went to wireless completely. And similarly, or even on regulation, right? On the investment advisory regulation, some of the developed nations are still figuring out some of the regulation, and we have we are ahead in those things, right? Investor protection, making sure those checks and balances are there. So yeah, great point that we are just getting started, and I believe there's a long way to go, but very bright, right?
Yes.
So,
absolutely. I think, from a regulatory perspective, if you look at the investment behavior has still been very transactional.
Correct.
I think that is set to change, and I will give a lot of credit to the regulator for coming in and, aiding that sort of change going forward.
So, though the yields, you mentioned about the yields, right? And the interest rates in the developed nations. So yields over here also now in the recent months have gone up, but interest rates have been quite low during 2020, right? And returns on savings banks, liquid funds, fixed deposits are lower. There is also risk aversion because of the credit fund, whatever has happened in the past 2-3 years on the credit funds. So do you think investors should increase the allocation to equities in such a scenario?
Hey, Anup, I think since you use the word risk, we believe it's a business of generating returns, while actually it is a business of managing risks. And that is very fundamental to every individual. And when you look at investments, everybody's investment life is very personal because their lives are very different. Yours and mine life are very different. We are at different ages, and hence we would be at a different trajectory in life on our needs and wants. More than allocation, first let me come to the basic fundamentals of investing. And then the basic fundamentals of investing is asking yourself why you are investing. That's stage one. I mean, till you do not know why you are investing, you will never know where to invest. And if you know why to invest, there are enough capable people around you who can help you in where to invest and taking you to that why. So hence the fundamental thing about investing is goal planning. Once you get your goal, because everybody's goal is different. So there is no one fixed rule of investing across the world. Every individual has their own life, and everybody's life is correct, right? It's my wish. I want to have one life. I would like to lead it in a certain way. So once you have a goal plan in your life and you have a certain amount of money and you get into a financial plan with the help of an advisor, which you were referring to, is what the regulator is now shifting this world. And to reflect on the previous question on UK versus US and us, it is a complete plan market there, right? And to the extent that in some countries, the advisor is now accountable for the advice. It's gone that deep, right? We are at the threshold of that. And I do believe that going forward, the difference between what used to happen and what will happen is planning of investments, catering of investments or tailor-made to suit his or her own life and life goals. Right, because as you rightly said, interest rates are coming down. So gone are those days when you could really rely on fixed income instruments, even by the sovereign. And there was some indication just a few days back on the
Yeah, I was
PFAs
going to
going
refer to
down.
that. Yeah.
So there is no escape from that. If not today, tomorrow it's going to happen, and sooner we realize that, better it is for us. I mean, why should the government take the responsibility of committing certain returns to us when we ourselves know year on year the government is on a deficit financing, right? So the burden will only grow, and hence in the future, like other countries, outsourcing that or that getting privatized is a matter of time. So once these realizations sink in, the real advisory will start growing, which is beginning to happen. So the most important part is to set the goal, know your finances, get a good advisor like you, because you are a registered advisor. And then what the advisor does or prompts you to do is know your risk profiling. Correct me if I'm wrong, Anup, at any point of time in this, because this is more your domain than my domain. Because the most important part of everybody's financial life or financial investor in life is knowing his or her risk. And let me tell you, risk profiling is not a constant. All our risk profiling before COVID and after COVID would have changed. So I would urge every person listening to us at this moment to continuously on a yearly basis, or whenever you think at that time, go and review the risk profile. I'm sure there is a very good risk profile available on the Scripbox website, but there are enough risk profilers in the country. Be honest to yourself. Once the advisor and you fix up the risk profiling part, then you come to the plan. And once the plan is made, then we mutual fund guys come in, or the assets that you invest come in. This is such a clear deviation from what whenever people meet us, hey, which is your favorite scheme? Hey, do you need my favorite scheme? Because you're step 5, right? And once you form your assets are that, then the key remains in reviewing it at the right time and rebalancing whenever there is necessary. Please understand, it is a very simple process which just needs one thing, and that one thing is discipline. Let me give you a caveat. Worldwide, most of the financial plans fail because the discipline goes out. And when you see market movements during COVID, it's just a matter of time that it starts playing on your mind. And more rule-based the plan, the better it works. And that is why you need a good financial planner to stand by you. I think for me, the better role of the financial planner is to keep the investor on track, rather than suggesting which schemes and all are not the most important part of the plan. The other 5-6 factors are bigger factors of the plan, and staying on course to your plan is key to success. I mean, we were debating so much at the beginning of COVID, and there was so much of requirement, including the regulator coming and telling us that you should provide for pause of SIP. And we were saying that if you stop the SIP, you are going out of the path of your plan. I mean, somebody who would have gone through this entire process and stuck to his or her own SIP would be smiling today. So staying on course is the most important part of the plan. Yes, you must review the plan over a period of time. And on that, if there are necessary changes, which we call the rebalancing of the portfolio, those should be unemotionally and ruthlessly done. Once you follow this process over a period of time, there is no reason why you do not reach your goal. But the day you reach your goal, please get out and enjoy your goal.
Correct.
Don't let the markets then play on your mind. You've done it for a purpose. Live your purpose.
So most important thing is your goals, life aspirations, and how do you achieve those and have that discipline. So very well said about discipline. And in fact, I think one of the important things that you kind of alluded there is how do you take the emotion out of it, right? So this is where systems which rely on process, like a Scripbox platform and algorithms, and making sure that we have that emotion brought out, like, or taken away, right? The bias is taken away from the process of investing. That really helps in making sure that you stay the course and you have the discipline of investing regularly, like either through SIPs or making sure that those savings are there.
The sure short way of financial planning going down is emotions, number one. Bias is a form of an emotion. Falling in love with a particular instrument is another emotion. Only emotions. You take emotions out, make it more mathematical, more rule-based, and then follow the rule-based. And when you do that review, if some of the rules are working, change those rules. But don't get stuck to some things because of somebody telling you something, or India might look like this stock is looking like that. If that stock is looking like that and it fits your rule, then it falls into place. Otherwise, it does not. As simple as that.
So I've been reading that many investors have taken to trading as a career, and there's a birth of Robin Hood investors, right? Has 2020 really changed the rules of investing, according to you?
I think when you look at a sharp run-up like this, you start feeling money making in the capital markets is very easy, right? So there is that attraction, there is that certain romance that comes into stock picking. And see, let me tell you something. There is nothing wrong in somebody wanting to gain that ability to pick a stock. As people in the financial markets, one should be encouraged to do that. In that process, if somebody gains that ability, no bigger high than that, right? But don't get attracted because the markets have behaved in such a way on 1 year basis. Yes, because of the digitization, it's a natural progression that people start opening demat accounts. But I am not concluding that the demat accounts are only for stocks. That's number one. Because what is happening, and Anup and I are facing it on a daily basis, is that the way to invest in mutual funds till now has been practically the active side of the business.
Mm-hmm.
But when you look at paying fees to a fund manager, the fund manager tries to give you something above the market, which we call alpha. Once the markets become efficient information-wise, the alpha generation abilities start shrinking, which we are seeing already starting in India. Again, referring to UK and US, those are completely passive markets, right? But we are in this fantastic stage in India where active alpha generation is possible. And at the same time, some person who does not want to take this underperformance risk can start looking at the passive business. A lot of demat accounts, and I'm sitting on this side by virtue of that, I'm telling you this, a lot of demat accounts are also aiding the ETF movement, which is started in increasing in India. If you look at last month's industry market view or the figures, the active equity gave 9,500 crores positive inflow, while the passives gave 8,800 crores positive inflow. So slowly but surely, we are seeing the Indian investor maturing and looking at it more objectively than just hearsay, is what I would say. That is why both sides are beginning to sort of develop, and it's a good thing to see from our side. Yes, I do agree to your statement that when such a thing happens, certain people start feeling that let me buy some stocks, I'll make some money. Please understand the market is always smarter than you. And if you can get that right in your mind and again, form a rule-based form of picking stocks, going into the entire rationale of how a stock becomes good or if the valuation is right or not right. If you are able to master that, please buy stocks. There's no doubt or debate in my mind for that. But if you don't, or in this process you realize that you cannot, then there are enough advisors like, I mean, I'm sitting with one pedigree one right in front of me, Scripbox, who can help you in this process, both in the form of identifying a fund. My humble request is once you have understood that you do not want to pick stocks directly, or you do not have the ability to pick stocks directly and come to an asset manager to help you do that, then leave it to the asset manager to do that for you. Don't then double hat, right? It will be up to Scripbox to guide you on certain principles on why a certain asset manager is good, or why a certain manager is good but may not suit your profile. All those discussions can be done with Scriptbox. But my humble request is, once you are with an asset manager, then trust the asset manager for the period of time you've given him or her. The other part which I'd like to mention, because of demat accounts, this also starts seeing, and we are seeing the industry figures unfold, is that there is this concept of profit booking in mutual funds. It practically defeats the purpose, because you've hired a fund manager to book your profits. And when he or she books your profits on behalf, actually he has a tax advantage which you do not. He is tax-free, while you will incur your own taxes. Please keep that in your mind. Even after that, if you feel you can book profits on mutual funds, I have a simple request to make. The day you have seen the overall market and booked your profit, I would simply request you to put the NAV or the exit NAV in your notepad somewhere. Next time when you come into that same fund, please look at the NAV at which you are entering. Typically, and then you come in at one point of time, and if that fund has outperformed the market, which is why we hire a fund manager, the NAVs are different. So if you are booking the profit, don't book the profit on the market. Please write down the exit NAV, and when you come back again, look at the NAV at which you are entering. Over a period of time, you would understand what I'm trying to say or what I'm not saying.
I think you make very important points, Swarup, that risk profiling that you had mentioned earlier, and making sure that you understand why you are investing. So accordingly, there are different ways of investing. So whether it's active investing that you're doing, or passive investment through ETFs and index funds. So the choices are increasing, and making sure that, but everything may not be there for everyone, right? So you need to kind of decide about what you want as your investment portfolio, what is your risk profile, and accordingly, and take help of advisors or experts, right? So that's why actually this delves right into my next question. So do you see a change in the role of investment advisors in this new world order?
I see a complete change in the role of advisors in the new order. Like I said, till now, broadly the investment has been very transactional. Oh, this is a good fund, let me invest. I think you might look at a good fund, for all you know, it may not cater to your needs at all. Is a realization which has to come, and which is beginning to come. Because finally, the more important thing in your life is your investment goals, not which fund you are investing in, right? And that realization is beginning to that. So I always say that the star in your financial plan is your goal. But the person who takes an investor to his or her goal is the rock star. And the rock star is the advisor. Please understand, the rock stars, and this I'm talking to the listeners, the rock star's role is not to select a good fund. That is a given, which comes as part or parcel of the role that he or she carries. The more important or the most pertinent part of the advisor's job is to suggest schemes or investment avenues which cater to your risk profile. There might be a great fund from Mirae Asset which will not suit your risk profile at all. Form a plan which you will be comfortable investing in. That is more important. Secondly, once a plan is formed and executed, staying on course of that plan is one of the biggest role of the advisor. And third part, which is regular review of your plan. It's a world where even the best make mistakes. I give this very pertinent recent example, and when you look at investing the world over, the god is Warren Buffett of active investing. And recently, just before the COVID times, he sold the airline stocks out of his portfolio. And you should know that post Warren Buffett selling airline stocks, the airline index has shot up 80%. So even God can make mistakes. So if there are certain mistakes in the portfolio, how to correct them and come back to course is something which an advisor can help you do. But most important, I think the advisor's role is on the day of your goal achievement, making your plan tangible. Suppose you have you're just for discussion's sake, we are aiming to buy a car. On that day, trust me, on that day, there could be a situation where the markets will look so attractive that you will say, okay, I had aimed for a Santro, let me opt for a bigger car. Just example. It's the role of the advisor to get you out of the market and go and deliver that car for you. So I see two things. One is the ability of the advisor to deliver that intangible financial plan into a tangible. And more when the tangible start happening in a person's life, that person starts appreciating the process of financial planning. And I feel because the young today do not have the kind of economic baggage which my generation has, they will be far more open. They are already far more open, and they will be more suited for financial advising than my generation is an observation. And I think I'm very correct on the next generation being far more savvy financially, meaning in financial investing than we were. See, we've come from a different world. Our fixed income were very good. Real estate was cheap. I was not inheriting anything, so I had to, I stayed in Mumbai. My parents are in Bhubaneswar. That house in Bhubaneswar, even if I want to get it, I won't be staying there. So lives are changed, right? And so going forward, the way that same person in India will view at investing will be far more plan-based and transaction-based in the past. And that is where is this great opportunity for a financial advisor to come in and put down an income statement, rejig the income statement in such a way that he or she starts investing in financial assets more than they had in the past. So the future, I do believe, belongs to financial advisors going forward from here on.
Yes. So yeah, well said, Swarup. So financial planning, then selecting funds and creating a portfolio. Then comes the first creating the portfolio actually, then selecting funds, and then making sure that you execute, monitor, right, do all that. So planning becomes very, very important in order to make sure that you achieve your goals, and that's where advisors can help, and that's where Scripbox is also helping our customers, making sure that we make a plan, we stick to the plan, and kind of make sure that there's a portfolio that is generated, right, which helps support your aspirations and goals. Before I move on to the audience questions, so there are a lot of good questions that have come up actually. I just wanted to ask one last question to you, and then we'll move on to audience questions. Lately, especially in the last 2 weeks, I've seen there's been a surge in the number of COVID cases with the second wave. Besides the precautions of wearing a mask and social distancing, any message you'd like to give to our viewers on how to deal with the current situation, whether it's investment, personal, or anything that you would like to add there?
Let me start with the personal one. I was COVID positive in November. I've seen this very up close and personal. So it's not something which is good having. Okay, that's one. Number two, which I would like to tell, and that's because it's an emotional thing. The day anybody feels a little bit of discomfort, my humble request, so isolate yourself in a room. And I mean, since we are in Mumbai, we are a little more aware than Bangalore because our cases are at a different level. Trust me, all houses in Mumbai have one designated room already prefixed. If there's something COVID, this is where we will what do you call that? Isolate them. But the day you feel a little bit different, do the test that day. It is just a very normal, mouth swab and a nose swab. It's not an injection or anything. The sooner you get the report, better for you to recover. Because please understand, the day you get your report, your 14-day quarantine starts from that day, officially. So suppose I feel today and I test on the 5th day and I get the report on the 6th day. So my tenure, which should have been 14 days, will stretch to 20 days. So practically speaking, number one, then you isolate the chance or minimize the chance of spreading it to the rest of your family. That has been a personal sort of experience, or what I'd like to tell people of what I have gone through personally. And then within that period, eat well, drink a lot of water, at least 4 to 5 liters if you are positive. It's not a problem. Today, the mortality rate is okay. It's not a life-threatening thing unless you have other complexities within yourself. But those complexities are also getting, it's a known animal now more than what it was, say, when I was, it's just a matter of 5 months. 5 months, a lot of change. The medication which I went through is no longer being given today. So a lot of work is being done on that. The other part is, when you look at, and if you are the earning member of your family, please take care that you start having your emergency fund intact. Normally, I'll give you again, reflecting on that earlier, I would feel a 6-month emergency fund was good for me. But post-COVID, I think I'm reviewing that very strictly. And economies are different. There could be, we finally go and do a job. And if my business becomes irrelevant, I might lose my job. Is a reality, right? So under those circumstances, how do you keep your family intact? Because I have that responsibility. And so those things also have to be kept in mind. That's a separate session completely. So think of how much emergency funds you have from a financial perspective. The emergency fund is cash at call, which you can just withdraw like that. And the day you feel anything, either test that day.
Those are very good tips, Swarup, and I'm very glad that you came out of it and without any problems. So thank you, and glad that you are safe and everyone is safe. So Swarup, actually, there are very good questions, and in fact, one of the things that I wanted to just quickly mention is there was one thing. I'm just reading some of the questions. That what is Mirae's tax saver fund has positively helped me achieving my goals. So that's a good
Thank you so much for saying that. You made my day.
And yes, I think Mirae has been doing a good job. So yes, that's fantastic. There was an interesting question on Bitcoins. Yeah. This was, could you also share light on investing in Bitcoins and RBI's ban on the same? So do you have any view on that?
I have very little knowledge on that, to be very honest. And I think the world is catching up. Like I said, it will be a very different world going forward. If Tesla is available to you in Bitcoins, that itself is something which is telling. Whether it will rise up to be a currency in future, I am too small a man to sort of comment. But again, if somebody understands that and looks at it from a fundamental basis, one is good. But I really do not have much knowledge on Bitcoins, and I stay away from it because I don't know it and I don't understand it, to be very honest, Anup.
I think you make an important point, and it's good that you mentioned that many times we may not understand an investing option. So in such a case, we will be increasing a lot of risk if we just go with that because everyone else is doing it, or we are just kind of hearing about it a lot. So it's very important that we don't run after something which we don't understand, and stick to our kind of goals and things that which is risk management that we are talking about, right?
Yes. And it's a business of risk. Finally, if somebody likes that risk, then so be it. But it's not falling into my risk parameter, and within investment plan, my current asset allocation is taking me on to the goals. It had wavered a little pre-COVID. I did a good rebalance in the month of April. I actually did a Facebook Live to say that I'm rebalancing my portfolio, and it's helped me on the comeback.
One of the questions, Swarup, is, should I enter the market at these high valuations?
Yeah, no, I have a very fundamental answer to that question. When is the right time to invest? I always believe the right time to invest is when you have the money. If you know where to invest, please do it yourself. If you do not know, hire a good advisor and a good fund manager. They will take care of the money for you. Don't worry about the markets. The moment you think you know the markets will surprise you. So the markets will behave on a demand supply sort of basis. And at this moment, when you look at a growth country and the world is starved of growth countries, India is one of those few countries that is showing growth post-COVID. It will be a hotbed for a lot of money to come in. So that's a reality. We are in a good zone at this moment. Near term, the second phase of COVID is far more real than the first one. I was just talking to a doctor friend of mine, and he believes this strand is more conducive for our weather condition than the first one which came. So this could be far more severe than the first one. That could lead to some near-term volatility. But you have seen what the earlier volatility has done. Volatility is your best friend if you are a capital markets investor. And in volatility always lies the opportunity for fund managers and stock pickers. So if there is more volatility, you should welcome it, and a good planner should help you mitigate that volatility very effectively. So if you have the money today, please invest today.
I remember, I think I talked to you last year, right, on a podcast, and we talked about volatility, and you mentioned this volatility.
We had discussed that, right? Right, absolutely.
Volatility is your friend, right? So definitely, yes, I remember that.
And we had said invest now, we'll talk after a year.
Yes, exactly. So there's a question on MF versus Indian stocks versus US stocks, and also which is the right investment option, fund of funds or index fund?
It's a very pertinent question, because let's face something, India is a growing country, is a fast growing country, no denying that. But when you put India against the globe, please understand, in spite of its growth and everything, we are 3% of global GDP. From a market capitalization, that is the size of the market, we are 3 to 4% of the global markets. So nearly the bulk of of the capital markets are outside India. That's point number one. So till now, we were good with Indian markets performing in a certain way, and we have invested and taken a journey. But the time has come when you have to look at other countries as well. Because if you look at post 2008 to 2020, if I were to give you some data, India would have performed 4 out of those, would be the top country 3 or 4 times out of the 12 years, while US would be the top country 6 out of 12 years, right? And India would be the bottom in 3 or 4 times. Similarly, US would be 3 to 4 times at the bottom. So it's very difficult to predict which country will go ahead in which way. The other part is, when you look at stock markets perspective, we are an emerging market or an emerging economy. So a lot of industries that we have, when you compare to growth countries like US, are typically old economy. Look at our sectors. We say the 4 pillars of India are infrastructure, healthcare, banking, and say consumption. These would form our broad investment horizon. But for them, they are beyond this. This part is given, right? For them, it is automation, it is technology, it is artificial intelligence, robotics. They have gone technology heavy far more than what India is. So clearly, there is very little correlation between India and them. And that is why this bigger case of owning both. Right here again, a good planner might come in and help you in this diversification. But the good part of what you are getting in both these countries by owning both together are complementary portfolios. Very little in common of what you will get in the US to what you are getting in India. So it's a natural progression. Yes, it leads to maturity of an investor, and I think we have reached there. So hence, you will get a lot of articles talking about international investing. We ourselves are launching a fund next week on international in the US 10 stocks. So it's a lot happening because there is a logic to that. Number 2, when it comes to index versus fund of funds, right? I would like to introduce one more animal called the ETFs in that, because clearly the index fund, there are 2 ways of investing. One is the passive way of investing and the active way of investing. When you hire a fund manager from Mirae Asset or equity team, you are perform better by than the market. But in the process, there is also a risk of underperforming the market. So some people will say, okay, let me not take this underperformance and let me buy the market. Some of the newcomers would do well to buy the market first and then go to active investors. So in that active part, there are 2 ways of owning. One is the index fund, one is the ETF. ETF is through a demat form where you buy real time. It's like a stock. But index is the end of the day NAV, like an active fund. So the real way of investing passively finally is the ETF, which most of the countries now align to. India, both are there, so the choice is yours. There's not much difference between the 2. If you're okay with day and NAV, it's okay. If you are not, then you can take the ETF route, right? The fund of funds comes in to help you invest if you do not have a demat account, clearly. But clearly there is a cost differential. The fund of funds would be slightly more expensive than the underlying because it is over and above that. Typically, the ETF is the cheapest. Just to give you an example, say how can I put it? Say all the index funds in the large cap or the Nifty 50 in the index fund, the cost would be around, I think, between 50 and 60 basis points, between 30 and 40 basis points, if I'm not right. But while in the ETF route, it's 7 to 8 basis points. So you have to choose everything. Like Anup says that, you have to choose what is right for you. Right? Both are passive ways of investing.
So, Swarup, I'll make two comments. One is, obviously a lot of appreciation for Mirae Asset. So I definitely want to read that out. It says Miss Mirae Asset and Mohanty. So personally has helped me open an account for my daughter for me to do SIP for their future in their name. So I think there's a lot of appreciation for the Mirae Asset as a AMC and what you guys have done. So very good to kind of see that appreciation coming for you and the team. Swarup, the next last question I'll take. There are lots of questions, Swarup, but I don't think because of time constraint, we will be able to take all of those. Hi, Mohanty, sir. How much minimum and maximum percentage of our portfolio should be invested in Mirae, FANG, NFO? Thanks in advance. So I think it relates to what you were saying about your new.
Yes. FANG Plus is a 10 stock portfolio. Incredible 10 companies that are there in the US, ahead of the time companies which from Facebook to Tesla are those 10 stocks. The beauty of the fund is it is 10% per stock and it is rebalanced every quarter. So it's a very rule-based sort of fund, taking away any sort of emotions or market action on it. It's a ruthlessly rebalanced every quarter sort of thing. Means the stock prices will reverse to the mean every quarter. The stock price which is lower will get higher allocation after that quarter. The stock price which has gone up will be corrected to 10%. So it being rule-based, it will be followed tenaciously, perpetually, right? And the second part is, allocation is something which between you and your advisor. I do say that there is a space for global investing. Within global investing, whatever you would have demarcated, please talk to your advisor as per your plan, make that allocation. But yes, I'd like to just make a very simple sort of statements. And statement is that when you look at these 10 stocks, this 10 stocks market cap is 7.7 trillion. Please understand, India is a 2.5 trillion economy. Those 10 stocks technically are 3 times the size of India. So that's what we are talking about, or the power or the size of these 10 companies. At the same time, they have been the leaders in R&D, that is investing in themselves to be ahead of the curve at all points of time. These are 10 companies which, even if you want to avoid sitting in India, it will be very difficult for you to avoid any one of them. I avoided Facebook all my life till Facebook bought over WhatsApp. Now I cannot avoid. I got out of Apple recently, saying that, let me try other products, but I love music, so I cannot get out of Apple Music. So they're just not a phone company, or say Tesla is no longer just a car company. They're far beyond that. And that's what makes them so great and so compulsive, is my only take. But how much you will allocate is between you and your advisor.
Yeah, and you know who to contact as an advisor, right?
Yes, please.
So, Swarup, I think that was there are still a lot of questions, but I think we have time constraints. So I'll wrap it up over here. For other questions, probably what I would suggest is we'll get back to the viewers about that, or we will kind of, you can please contact us or your relationship manager. So those are very valuable insights, Swarup. Thank you very much, and really love chatting with you on different aspects. And viewers, if you have further queries, please contact your relationship manager or use our website, scripbox.com, to get answers. For all your financial and investment related requirements, please download our mobile app. Do visit us on various social media platforms and subscribe to our channel, Scripbox on YouTube. If you have liked this webinar, which I'm sure you would have, Swarup is a great kind of communicator, and kind of his ideas are like great in terms of, and I've heard him talk about various investing aspect in various forums. So do talk about this webinar on social media platforms. So Swarup, anything you would like to say to the audience?
No, thank you so much for all the appreciation for our funds. Let me tell you, our fund management team does put in a lot of effort to keep them on track, and it'll be our endeavor to keep that going. Just have trust and faith on us like you have, and it'll be our utmost endeavor to keep the funds the way they are going forward. Thank you so much for your kind words, Anup, and the opportunity to come and speak to your investors. Really.
Thank you, Swarup. It's been a pleasure having you and a pleasure talking to you. In fact, there was one more comment that came. Awesome insights, Swarup. So I think the viewers have already kind of given their stamp of approval. Thank you to all the participants for joining us today. We hope to see you again in our forthcoming webinars. This is Anup Bansal from Scripbox, wishing all of you the best of health.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.